All right, let's dive right in. We are looking at a huge story playing out right now, where the worlds of artificial intelligence and high-stakes finance are colliding. And get this, a financial ghost from the 2008 crisis? It's back, and it's flashing a major warning sign for one of the biggest names in tech.
It all comes down to this one massive question. How is this multi-trillion-dollar AI revolution actually going to be paid for? I mean, for a while, the big tech giants, the hyperscalers, they were just using their own piles of cash. But that's starting to change in a big way, and it's exposing a pretty serious financial fault line.
That's right, a financial fear gauge that pretty much became famous or infamous during the 2008 crisis is now spiking like crazy for a major tech player. And that is sending a real wave of anxiety through the credit markets. And the company right in the middle of this whole storm is Oracle. They are making a massive, and I mean massive, bet on AI that's fueled almost entirely by debt. And while the market is starting to get really, really nervous.
Okay, so this is the number that has everyone talking, 1.28%. Now, what is that? That is the annual cost to insure Oracle's debt against a default. To give you some perspective, that insurance policy hasn't been this expensive since the absolute height of the 2008 financial crisis. Wild.
And, this isn't some slow-moving trend. The price for this protection has more than tripled in just a few short months. A spike that fast and that steep makes credit traders sit up and pay very, very close attention. So what's so different about Oracle's high-risk, high-reward play here?
This really captures the two completely different playbooks in the AI race. On one side, you've got giants like Microsoft and Google. They're funding their huge AI build-out with their own massive cash flows. It's like building a fortress, Very little borrowed money. And then you have Oracle. They are going all in, funding their AI push with billions and billions in new debt. With a weaker credit rating to start with and a projection that their debt will triple, well, it's a classic high-leverage gamble.
So to really get what's happening here, we need to understand the tool that's measuring all this fear, the credit default swap, or CDS. For a lot of us, that term probably brings back some pretty stressful memories of 2008, so let's do a quick, super simple breakdown of what it actually is.
Okay, think of a CDS in the simplest way possible. It's basically an insurance policy on a company's IOU. So if you lend a company money by buying its bond, you can also buy this insurance policy. You pay a little bit each year, that's the premium, and if that company can't pay you back, the insurer steps in and covers your losses. Simple as that.
Let's just walk through it real quick. So first, imagine an investor owns an Oracle bond. Next, they're a little worried about the risk, so they buy protection, a CDS, and they pay that annual fee. Now, if the worst case scenario happens and Oracle were to default on that bond, boom, that CDS contract pays out and the investor gets their money back. And this is the absolute bottom line. The price of a CDS and the perceived risk of a company defaulting are basically two sides of the same coin. When the market starts to think the risk is going up, the price of that insurance policy, the CDS, goes right up along with it.
So you see a CDS price spike like this, and your first instinct might be to hit the panic button. But is it really that simple? The story here is actually a bit more complicated than just a straightforward fear of Oracle going under.
In fact, as one analyst over at Bloomberg put it, it's not quite time to panic just yet. This price surge is a mix of two things. Yeah, there are some real business risks, the fundamental reasons, but there are also some purely technical, kind of weird quirks of the financial markets at play.
So what are these technical drivers? Well, first off, hedging. Banks have loaned billions to other private data centers, and they need to insure against that risk. Oracle's CDS is a handy, if not perfect, way for them to do that. Second, you've got momentum trading. Once the story hits the news, hedge funds pile in, betting the price will keep climbing, which, of course, makes the price keep climbing. It's a self-fulfilling prophecy. And finally, it's just simple supply and demand. A lot of people want to buy this insurance, but almost nobody wants to sell it, so the price just skyrockets. But look, all those technical reasons aside, there is a real, fundamental fire that's causing all this smoke. Oracle is pouring so much money into AI that its free cash flow, the cash left over after paying all the bills and making big investments, is expected to be, and this is a quote, massively negative. And to fill that huge hole, what do they have to do? They have to take on even more debt, which just creates more risk for the market to worry about. Because it's one of the first huge tech players to fund its AI dreams almost entirely with debt, Oracle has kind of become the canary in the coal mine for the whole industry. How the market reacts to their strategy could be a preview of what's to come for any other company that tries to borrow its way to the top of the AI world. I mean, this chart just makes it crystal clear, doesn't it? To insure $10 million of Oracle's debt for 1 year, it'll cost you about $128,000. Now look at the cost for Meta or Microsoft and Amazon. It's not even in the same ballpark. Credit investors are shouting from the rooftops that they see a level of risk in Oracle's AI plan that just doesn't exist with its cash-rich competitors.
So, what should you be watching for as this whole story unfolds? First, keep an eye out for headlines about Oracle taking on even more debt. Second, see if the insurance costs for its competitors start to creep up too. Third, watch the stock price. A long, sustained drop can signal that credit stress is spilling over. And finally, and this is the big one, are the profits from their big AI bet actually big enough to cover the massive interest payments on all this new debt?
And that really leaves us with the big, multi-trillion-dollar question. Is this crazy spike in Oracle's risk profile just a one-off thing, a unique situation for a company taking a huge gamble? Or are we seeing the very first tremor of a much larger AI debt quake, one that's getting ready to shake the very foundations of this entire tech revolution?